So, hey everyone, I want to thank you for attending the Place Your Trades Network Spaces covering GCC nations and Africa energy markets into 2023 and beyond, and how you can use event contracts to trade natural gas and crude oil. The space is brought to you by TraderBait, which has a custom web app dedicated to trading event contracts. You can use the link in my Twitter stream to go and get the TraderBait app for free. I also write a weekly blog on energy and metals that you can find at placeyourtrades.com. So I'll introduce all our guests first. First, we have Joe McMonigle, which we haven't been on a podcast together in a very long time. So I'm looking forward to this. He's IEF Secretary General of the International Energy Forum, which is the largest international organization of energy ministers. It's based in the diplomatic quarter in Riyadh, Saudi Arabia. He has over 20 years experience working on energy issues in the public and private sectors. He served as Chief of Staff at the U.S. Department of Energy during the first term of the Bush administration, helping manage a cabinet agency with $23 billion budget and over 100,000 federal and contract employees. In addition, he serves as 2 years Vice Chairman and U.S. Representative to IEA, and the U.S. co-chair of U.S.-China Energy Working Group. Prior to that, Joe was president and co-founder of the Abraham Group. It was a leading international energy sector management consulting firm based in Washington, D.C., and senior analyst at Hedgeye. Then we have Ali Shahibi. Ali is an author and commentator on Middle Eastern politics and economics with a particular focus on Saudi Arabia. After a career in banking based out of Riyadh and Dubai, he retired from finance to write. He has authored 2 books, The Saudi Kingdom Between Jihadi Hammer and the Iranian Anvil, and Arabian War Games, a work of fiction. He is widely published in elite media, including the New York Times, Washington Post, The Atlantic, Foreign Policy, among other publications. He's a graduate of Princeton University with a BA in politics and Harvard Business School with an MBA. We have Aya, she's not up here yet, hopefully she will. She's an expert and public commentator on security with special focus on Libya. She's the founder and director of a nonprofit, Code for the Road. For a decade, Aya was also a senior analyst at the Research Institute for European and American Studies, where she specialized in extremism and conflicts in North Africa, Europe, and the Balkans. Then we have Abdulaziz, who is a prominent public Saudi speaker on energy and climate issues, and a public speaker for major energy issues for the Chamber of Commerce, municipalities, and other entities in the Middle East. He's a geophysical modeling specialist who has a master's in geophysics from KFUPM and a higher education diploma in geophysics and the oil business from the Institut Français du Pétrole. For the past 15 years, he has been an avid observer of E&P activities in the MENA region. He reports daily on regional competitors and activities in the upstream sector, as well as reporting quarterly updates on updated business activities globally and in the region, including monitoring of all oil and gas discoveries in the Middle East, North Africa, and global frontier areas. All right, now that we have our introductions, we will go ahead and I'll start with Joe. Joe, it's been a while.
It's been a while, yes. Good to be here.
And good to have you. So kind of like broadly give us kind of your 2023 outlook for GCC nations and Africa, whether that be IEF members or not, as far as hydrocarbons are concerned. And then go a little bit into, is there enough being addressed on the supply side of things? I know you've discussed the upstream investment shortfalls in oil and gas. So really, what are those estimates looking like? And how is this going to affect the markets going forward? Are we going to get higher for longer?
Yes, so it's great to be here. I'm kind of amused because you're following after the EIA data is released, and when I was at Hedge, I used to, of course, religiously follow the weekly data, and now I hardly ever pay attention to it. So I'm probably not the right person to talk about the data. But let me respond to your question and talk a little bit about the macro environment for 2023 and beyond. I think going into 2023, we saw a lot of uncertainty, mostly on the demand side, and I think to some extent that still holds in terms of the recession and bad economic outlooks that essentially every major financial institution and World Bank and IMF and others all are forecasting. And the other was, I think, on China and China demand risk and what may or may not happen vis-a-vis the zero COVID policy. But that seems to be in full mode now with the Lunar New Year holiday. But even before, I have to say, we just came out last week with the Jody data that the IAF collects and publishes on a monthly basis, and we get it supplied from member countries. So it's a little behind, some of the others were about 2 months behind. So the data was actually for November, but even in November, China demand was up by 1 million barrels a day, and imports were up about 1.4 million barrels a day. So this is November, way before the zero COVID policy was lifted. So I think we're about to see demand in China take off unless there's some kind of catastrophic, black swan event. On the supply side, we have a lot of problems, and I think underinvestment is probably the biggest problem. We're obviously, like everybody else, closely watching to see what may or may not happen to Russia supply. But I would say, without adequate inventories, spare capacity and investment, I think volatility is likely here to stay. I kind of say I think there's a tale of two markets here. You have the financial market, which is almost solely focused on the recession narrative and bad economic news, but the physical markets I think are still quite strong, and so I think OPEC and others are trying to try to thread the needle with regard to both of these markets. In terms of investment, we do issue an investment report every year. We started in 2020 during the pandemic because what you saw, everyone of course saw this, was capex cuts by IOCs and NOCs, and obviously we were concerned about what that might mean, and we basically have followed it now since 2020, and at the end of each year issue a report. And over the last 2 years, the report has basically showed that capex cuts were about 25% vis-a-vis pre-COVID levels, and investment needed to sort of dramatically increase just to meet demand. We're coming out with a new report in about 10 days to 2 weeks. We're still trying to nail down some of the data, but I can give a little bit of a preview for it. We're doing it with our partners, S&P Global. And essentially what we've concluded in this latest report is that upstream investment needs to increase from about $499 billion in 2022 to about $640 billion in 2030. And this is a higher cost estimate than a year ago, which was about $525 billion that we said in that report. But it's higher because, costs are rising like everything else. Cumulatively, we think $4.9 trillion are going to be needed between 2023 and 2030 just to meet market needs and avoid a shortfall. And we're not talking about just a lot of new supply, but addressing this whole issue of production declines and offsetting production declines. And one of I think the key data points in the report that will come out again in about 2 weeks is that without additional drilling, we estimate that non-OPEC production would decline by about 9 million barrels per day by 2026 and 17 billion barrels per day by 2030. That's a 31% decline. So, it may seem odd for the head of an international energy agency of member governments to be talking about more investment in hydrocarbons, but that's exactly what I'm doing, because I'm concerned that if we don't address it, if investment continues to be constrained in hydrocarbons, I'm concerned that high prices and volatility is going to be the new normal. And and lastly, let me just conclude by saying I also think if you care about climate change and the energy transition, you should be concerned about this as well, because underinvestment, not just threatens energy security in the short and medium term, but it can also undermine progress on climate change. And that's because if the public starts to equate high energy prices and volatility with climate policies or the energy transition, we're in big trouble. We risk losing public support. And so we have to be careful. We have to manage the transition. And that means, until we find alternatives to meet our climate goals, we need to keep investing in hydrocarbons. So I'll end there and happy to take questions later.
Excellent, thank you. We'll go to the next. We'll go around to each person, and then we'll see if there's any questions and try to get more of a roundtable discussion. But so I will move on to Ali. I know so there's lots of. I saw an interview with you, but there are a lot of questions surrounding the matter of spare capacity, particularly in Saudi Arabia and UAE. I know it's been a big point of discussion, especially in the Twitter world and in the oil and gas Twitter world. Could you kind of walk us through that a little bit?
I think what happened was all the noise that came out of the post-Vienna OPEC meeting, particularly the noise that came out of Washington. And I think there was a fundamental misunderstanding of the Saudi position, where Saudi had made very clear before OPEC and since then that it wants to work and has always worked to keep price in a stable range, defined here as between $80 to $100. Now that obviously serves Saudi Arabia's national interests, because Saudi Arabia requires that money to fund its growth. But it also addresses the underinvestment issue, because if the price of oil had collapsed, as Saudi Arabia had predicted it would if production had been increased, that would have driven that would have made the underinvestment problem that Joe was talking about even more acute, because it would have sent signals to the markets and to lenders and to financiers and to equity holders in the oil industry about the dangers of investing in production capacity. So, the CEO of Aramco came out recently again and spoke to that in Davos and said that, as Joe said, we are very worried about underinvestment. Saudi Arabia is doing its share in investing and increasing its capacity. But beyond that, what it can do is contribute to market stability and not allow the price to gyrate or collapse when it saw correctly in the third quarter that demand would be weaker. And time has proven that OPEC decision to be correct, as it has proven the OPEC decision in December to be correct also. So I think there was a lot of noise and politically toxic sort of criticism that came out of Washington post the Vienna meeting that has turned out to be incorrect, really. And I think time has proven the kingdom to have been right about that, and to be right about the strategy going forward, which is investing in spare capacity, increasing its spare capacity, and increasing its general capacity. But beyond that, it can't do more than its own capabilities allow it to do, and the rest of the world has to cooperate.
then one other question, we just wrote a bunch of articles just came out that basically said Saudi days of unconditional foreign aid are over. Can you kind of walk us through this, and really more to the point is how, they've funded a lot of energy projects overseas. So how is this going to affect energy projects abroad?
I think energy projects were a very minor part of Saudi foreign aid. Saudi gave enormous amounts of foreign aid to a number of countries in the Middle East, particularly. And I think the feeling has been correctly that a lot of that money was wasted. And that not only did Saudi Arabia not get credit for it among the people of those countries, but that those economies continued to be addicted to an ongoing blank check policy of Saudi and other Gulf governments that in a way encourage those countries to avoid the harsh decisions that they need to take to reform their economies. And going forward, the kingdom has said, its aid is going to be two-tracked. One, instead of giving just direct budgetary support, it will support these countries by acquiring assets. That means that those assets will contribute to the foreign exchange balances of those countries and support their economies, but at the same time give the Saudi owners, if you want, to the Saudi people who own the public investment fund that will be making those investments, a return on that investment. So on one side, the government is saying, we want our people to be able to generate a long-term return from this foreign assistance. And secondly, it will only give direct or other financial assistance to countries that engage in substantive reform in cooperation with multilateral organizations, particularly the World Bank and IMF. And again, to encourage those countries to make the hard decisions that they need to take, and to ensure that this is not a black hole that the countries keep on coming back for, with the expectation that there's a blank check policy coming out of the Gulf states.
Excellent, thank you. So we'll go to Abdulaziz. I just got word from Aya. She is running a bit late, so she will get in the room as soon as she can. But I want to kind of go back to Africa, and Abdulaziz, let's dive into Africa a little bit more. But kind of, what does the outlook look like broadly on a macro basis for oil and gas in 2023? And maybe touch a bit on, Algeria. Europe's looking to Algeria to help with gas. Do you foresee that coming kind of to fruition?
Oh, hello, Tracy, and hello to everyone. Actually, to pick up on answering this question, I'll take the line that Joe used, where the market is a tale of two markets in different directions. I would say the industry, the oil and gas industry, is a tale of two strategic directions. One strategic direction is to look at on the ground, above surface risk and mitigate that, as well as the subsurface risk that the companies are more concerned about to maintain that production. Joe has also mentioned that there was an elevated capex between 2022 and 2023 in the 20 to 30% increase. But that's also, we need to clarify that this increase in capex is only to maintain the production, which means that it costs more to keep those oil fields in most producing countries alive at the similar production numbers that they have been maintained throughout 2022. Now, the industry also is between two directions of what to do with the volatility that is associated with the commodity that they produce. And within that commodity risk is also the rerouting of the global oil dynamics that is the result of whether it is the restrictions on Russian oil flows or the restructuring of the global markets feeding into regions of deindustrialization, such as Europe, or a region that has more risks than usual. That is the East, China in particular, and what it wants to do with its zero COVID policy and how that could affect supply and how that would actually lead demand. We have to highlight as well that we are going through a time where the restructuring is affecting the fundamentals of the oil markets. That means there are major changes in the supply picture as well as major changes in the demand picture, which means that this change will definitely continue for 2023. I think for the Middle East and Africa in general, after COP27 in Cairo, COP28, which is due to be held in the United Arab Emirates, will be quite crucial for the industry in terms of mitigating the risk associated to climate, as well as mitigating the risk associated to what the industry wants to do in the arms of the national oil companies, as well as how the international oil companies would tip in or play along.
Well, I also had a question, like particularly, if we look at, inflation is rampant right now, still in, Africa in particular, well, globally, it's still not great. But, if you look at countries like Egypt, and Nigeria, do you feel that this is going to affect production in any way? I mean, Egypt's become a pretty big player in the natural gas market. Nigeria is struggling. In fact, let's talk about Nigeria a little bit. We've seen Western firms exiting the country. Equinor, in fact, just announced today that they are leaving. So is this going to be a problem compounded with inflation in these oil and gas producing nations in Africa?
One of the biggest highlights of 2022, particularly the third and fourth quarter of 2022, has been the currency war that we're witnessing and what happens with major currencies, particularly currencies related to the commodities, oil and gas, and how they would affect that picture. Going back to one of your questions about Algeria and Nigeria, both these countries are due to hold major bidding rounds throughout 2023. However, what we also notice is in North Africa, countries that usually hold bidding rounds like Libya or even Morocco and Mauritania, their calendar is empty. And what does that tell us about their involvement in the industry? That brings us to realize that the geopolitical risk associated to Algeria and Nigeria will probably push the leadership to pursue these bidding grounds, but it also brings in a lot of risk for the international oil companies and how they want to get into the region and incentivize both the oil and gas sector as well as how they are willing to inject capital into these markets. Other than let's say the Suriname basin, that means Guyana and Suriname, as well as Namibia, we have not seen major oil discoveries throughout 2021 or 2022. But there is a necessity that there are major discoveries to be made in the near future, 2023 as well as 2024, to make up for the expected increase in demand. I want to highlight something else. Most forecasts and most uh, uh, research based expectations indicate that we will probably witness a 2023 market of surplus. But that is not due to a lack of demand. Absolutely not. It's because supply is becoming rerouted globally from different directions to feed old markets. And that in itself is a major risk.
Well,
All good points. Did you want to add something, Joe? Go.
yeah, sure. Well, just on that last point, I mean, I'm a little nervous about the forecasts for more supply in 2023. I think if you look at some of the EIA forecasts, they've been off on some of the estimates of supply, and I'm more concerned about non-OPEC supply coming through at the forecasted levels than the OPEC side. But going back to your question about Africa, I think again maybe more there's some unique issues to Africa, but also it's also a macro issue as well. And I mentioned that even in our investment report that we're coming out with, we've raised the amount of investment needed from last year's report to reflect higher costs. Overall, oil and gas upstream CapEx increased 39% in 2022 to about $141 billion. That's the highest level since 2014 and 13% above pre-COVID levels. But the increased spending really reflects both rising costs, inflation, and some increased activity. But as was pointed out, we haven't really seen any big new supply adds in 2022 or 2021. The other thing I would say is Africa suffers from, I think, the same sort of negative investor sentiment and other hurdles to obtaining capital for these projects. I mean, obviously there are some unique things in different countries with bidding rounds, and I can't really go into those unique circumstances, but there are a lot of constraints, especially in Africa. Already the cost of capital for hydrocarbon projects is very, very expensive, no matter where you plan to do it. But if you're doing it in places like Africa, it's even more expensive. Even renewable projects, by the way, the cost of capital in places like Africa are much more expensive. So I think there's a problem with access to capital, and and some of this has to do with ESG investing and sustainability goals. At conferences, I attend and speak at, I hear a lot of the term stranded assets. We don't want to do this because of stranded assets. Well, in Africa, they have stranded lives right now, and they need to develop these countries and bring people out of it, not just energy poverty, but poverty in general. And so this is a big, big problem. It's about 600 million people without access to energy in Africa. And we need to focus on it like we focus on climate change, like we focused on the pandemic and getting a vaccine. It needs really global attention, and it has to be a raised priority.
Yeah, I mean, I think that's a very good point, because I think a lot of the Western thought is, we can just jump into renewable resources and everything's going to be fine
Tracy,
without looking at the other
yeah, just to
side.
give you one more example, I mean, Heathrow Airport in London consumes more energy than the entire country of Sierra Leone. And people in the West and OECD countries just don't get this. It's energy is like, it's so easy. I mean, we've had some problems in Europe this winter, but compared to what is going on in Africa right now, people just don't appreciate the size of the problem. And I have to say, leaders in Africa are getting a lot more vocal about their concerns and wanting to be treated fairly, and to be able to develop their hydrocarbon resources and get access to financing. And maybe I think it's time to rethink these multilateral financing agency bans on investments in hydrocarbons. They have some carve outs, but it's for like very, very unique circumstances. And we really need to have a whole rethink on African development, and that includes hydrocarbons.
Looks like Aziz fell out. Well, there are a lot of traders and investors in the room, so you probably can't discuss it. But are there? And this is for either one of you, because it looks like Aziz fell out. I just sent him another invite. But if there, are there any areas in Africa that look particularly interesting in the oil and gas sectors that maybe some are overlooking? That's for either one of you. All right, nobody wants to jump in and take that. Let's go back to some GCC nations and what we should be looking at there, and where do we see growth within GCC nations, or within OPEC, because we know that they've been struggling to even make their current quotas.
Yeah, I'll start. I mean, I guess I would say, OPEC. Obviously, there are very few OPEC countries that can increase their production, really I mean, obviously, Saudi Arabia is trying to develop more capabilities here, but because of the spare capacity issue, now both the UAE and Saudi Arabia have some extra spare capacity if it's necessary to add it back. But I guess, as I would say, I think I'm less concerned about OPEC production than I am about non-OPEC OPEC production. You mentioned that the OPEC plus member countries who are not even meeting their targets now. I think the cut was announced as a 2 million barrel a day cut, but in reality, it was only about 1 million barrels because a lot of the countries are meeting the targets, and that's because they just there wasn't investment made during the last couple of years to be able to counteract production declines and invest in new supply, and they weren't the only ones to do this. I would add that. As I mentioned the Jody data before for November, demand is already back to pre-COVID levels. It's like 103% of pre-COVID levels globally. Supply is only about 97% of pre-COVID levels. And I think the average person thinks this is because, Saudi Arabia or UAE or other GCC countries or OPEC are not producing, that they're the reason for the gap between supply and demand. But actually, half of the gap is from the United States, which is still not back to producing at pre-COVID highs. And the reason is for the same reason that these other OPEC countries haven't been able to make their targets, and it's because of a lack of investment. And there are a lot of different reasons in the U.S. It's not a lack of capital. And you could say maybe it's the capital is more expensive, but there's a lot of issues regarding capital discipline. Investors now wanting better returns in the sector. You could say it's regarding ESG pressures. There are a lot of different, I think, reasons behind it, but when you look at Africa or some of these other OPEC plus countries, it's really because of a lack of investment. But the same could be true in places like the United States and other non-OPEC countries.
that just kind of led me to, I was just thinking we'll kind of get off Africa for a minute. Do you see a real threat from, we have a lot of leftist governments that were just elected in South America. Do you see that, and, several countries have said, we don't want to produce hydrocarbons anymore. Now, whether that's realistic or not is a completely different story. But do you see that making matters worse, or do you think that it's kind of an impossibility and it's a lot more talk, than anything else?
Yeah, I mean, I guess there have been some elections in some of these countries, and just like in the United States, things are said during campaigns that when you can say it in campaign mode, but when you're in governing mode, it becomes a totally different. When you have to make some tough choices and face some realities, it's a different situation. I would say I don't think we've seen implementation of any policies yet that would curb supply in some of these non-OPEC countries. At the same time, I mean, I think we need to be mindful, and if you're any country, any non-OPEC country that's a producer, I think you have to be mindful about what can be done to encourage supply. In the United States, we keep talking to the producers and say, please produce more. I think we need to bring the investors into this conversation, because the investment narrative is still weighing on the sector. There's this capital discipline issue, which the companies are sort of self-imposing, but they're not doing it in a vacuum. They're doing it because of pressure from investors. And so I think what we should do is bring the investor and finance community into the same room with the producers and the government policymakers to talk about what we need to do. Bring the BlackRocks and the other big asset managers who've got ESG concerns and priorities that they're being asked to meet. Because I think at the end of the day, you have to understand that, as I said before, we if we're not careful and we allow high prices and volatility to be the new normal because of underinvestment, that will undermine public support for climate policies and the energy transition. And that's not something that any of us want to see. At least I don't, and my member countries don't. So I think it's really important that we be mindful about this, and the investment community is a big part of this. It needs to be a big part of this conversation.
Absolutely agree wholeheartedly. I see. I just came up, so we'll because I had to skip her, so we'll go to her. So I wanted to talk. Welcome. Thank you for joining us. I kind of want to talk about Libya a bit, since that's your real specialty. We've had a civil war. We have, fighting factions within the government, rather two separate governments right now. Can you tell us a little bit about that? And, how is that going to affect oil and gas production within the country? And how is this affecting relations with its neighbors, say Egypt or Algeria?
Hi, Tracy. It's good to be back and to be in the company of so many sharp knives. I apologize for being late. I was confused with the universal time, and I'm glad to be here. So a lot has been happening in Libya recently, especially since November. The political impasse still exists, but there's been a revived movement towards having elections this year, so Libya can finally have an elected and accountable government. The State Department has been visiting Benghazi. The new UN mission head has been quite active. And from the energy security perspective, this is very, very important, because I believe as long as there's this political impasse where there is a government that's not elected by the people, yet public funds are going to an unelected government, there's always a risk of oil being shut down again. Having said that, back in November, the new head of the NOC announced that there could be a deal with Italy, with Eni in specific, for further investments in the gas sector. And it seems this Saturday, this is going to go ahead. There will be a deal signed between Libya, the NOC, and Italy for an 8 billion investment in Libya's gas infrastructure. That is positive. All of our infrastructure is in dire need of investment, but that still doesn't solve the political context in Libya, the matter of legitimacy, good governance, and so forth. And this reminds me, speaking of good governance, this reminds me of the MOU that has been signed between the GNU and Turkey this past October, which was very problematic for Libyans, but also in specific to its neighbors and the EU, such as Greece and Egypt. This MOU between Turkey and Libya was strange, to say the least. Now, other of our other analysts have pointed out correctly, this is only an MOU. The hydrocarbon MOU is not legal, but it did announce an intention to do things that are illegal. And it announced this partnership between Turkey, where basically Turkey would be an automatic partner in all of Libya's energy explorations, offshore and onshore. And this raised the question with the hydrocarbon MOU, what is the GNU and Turkey talking about? Because at least as far as the oil is concerned, it's already been divided between the big players and Libya's NOC itself. And of course, the implication in which the Turks have clarified is that they're focusing on offshore exploration in territorial waters that belong to Greece, based on the previous MOU of 2019. So this has caused a huge diplomatic crisis. It is ongoing. We see how the lack of legitimate institutions in Libya can play out and threaten energy security of neighboring countries and the EU. So this matter is yet to be resolved. Recently, the Tripoli Appeals Court struck down this MOU. It pointed out something very, very basic. It pointed out that the GNU has no right to enter such agreements. And after that, another Libyan lawyer sued the government successfully to publish the full details of any agreements they have with Turkey in regards to hydrocarbon cooperation. Now, the agreement that we see today, it was actually leaked. There's been no official publication of these agreements that the government, the GNU, has taken place with Turkey. So there's a lot of mystery and question marks over what is the GNU, what kind of agreements and contracts the GNU has entered with Turkey, and of course questions of legitimacy. And that's it.
So do you foresee a time where, I know Libya's been struggling to get investment. It's been a difficult decade. Do you foresee this getting any better? Do you see them, kind of getting over this, getting to a place where it would seem more investable?
Well, I think with this investment from Eni, this is a huge step. I think this is like the biggest investment Eni has made in Libya since the revolution, and I think, and that's why it's so important to resolve the political impasse in Libya. No one wants to come and invest in a country where militias are roaming around in the capital, and there's no judiciary and there's no rule of law. And companies are very right to be wary of investing in a country where the rule of law is absent. So I think, the renewed, I think a lot of the big players, such as the United States and other countries, because of the war in Ukraine and energy security has once again come into the forefront, they're realizing that this situation is not tenable. And, they cannot, this is a situation that cannot continue like this. So there is a renewed effort to get serious, to make sure that the country is unified. Now, it's the army that controls all the oil, most of them, not all of them, the majority of the oil facilities in Libya. And if there's no unified military and a government that is accepted by all Libyans, there's always the risk that the Libyans would say, hey, we cannot have our public assets going to funding a government that has not been elected by us. So there's always that risk. And I think there's a realization in the international community that we need to solve this. We cannot have energy security without political security and a legitimate government. So let's see. Libya is one of these places that's full of surprises all the time. And perhaps this year is the year that we might see some order restored. And when that happens, I see investment not only in the energy sector, but in all sectors skyrocketing.
Excellent, thank you. And we'll go to Abdulaziz. I'm sorry you fell out before. Do you want to, I asked a question while you were gone and nobody wanted to take it. Maybe you will want to take it. Are there any areas or countries in Africa that are particularly interesting as far as oil and gas sector are concerned that maybe some are overlooking, or any new drilling or plans to drill in places that maybe we're not looking at? Because there are a lot of investors in this room, so I'm sure that would be something of interest to them if you want to answer that.
I'm very wary of answering any question that Ali or Abdullah. Oh, sorry. Sorry, Abdullah. I was just going to say that I was not going to answer any question. I'm wary of answering any question that Abdullah or Ali or the others have not answered yet.
Yeah, no, yeah, go. Yeah, Abdulaziz, you. Did he just drop out again? No. Okay. Oh, here he is. He's back. Do you want to answer that? Are you there? Hello? Okay, he's not there. Did you want to answer that? Hello? Can anybody hear me? Hello?
We hear you. We hear you.
People hear me? Oh, okay. Okay. All right. So nobody wants to answer. Oh, okay. Abdulaziz just fell out again. Okay, so moving on. So what else should we be particularly focused on right now as far as oil and gas, besides the fact that we have, capacity, we have a production shortfall, and is there any other things that, especially, again, as there's a lot of investors in here, what else do we really need to be focusing on that maybe we haven't touched on? That's for anyone to take.
Well, I guess I would say, again, just a 30,000 foot view. I was at Davos last week. I didn't fly in my own jet there. I took I took the airlines. But I would say, and we put out a video about this. I think there is starting to be, at events and conferences like Davos and other events that I go to, a recognition that the energy transition is really an energy revolution, and it's not going to be easy. I think prior to the energy crisis of last year, it had been sold to the public of we just need more wind and solar, and we can solve the climate crisis and the energy transition. And what we've learned is that we have structurally underinvested in hydrocarbons, which is actually now presenting problems in terms of prices and volatility and energy security. But the IEA came out with their technology report at the beginning of last week, and it's an update from a previous year. And essentially, what they say is, wind and solar help us meet about half of our climate goals. The other half has to come from new technologies that are not commercialized or invented or even envisioned. So until we have these alternatives, we have to keep investing in hydrocarbons. So I think, this is starting to become clear to people, even policymakers. I mean, you look at the countries that have, completely flipped on some of their energy policies over the last year. The other thing that I think people are starting to realize is the energy crisis was not caused by the war in Ukraine. Prices were already high last winter before the war in Ukraine started. Certainly, there's been a premium to prices and extra volatility because of the war. But I think it would be a mistake for one of the lessons learned from this energy crisis that to put the full blame on Russia. It's really this. It goes back to the structural underinvestment in supply, and we're doing this before there's any changes in demand. So I think this is a key takeaway. I think people are starting to realize that we have to manage the transition. It's not going to be easy. We have to keep our eye on the ball and definitely keep pursuing our targets, but we have to make sure we don't lose public support and make things worse as we aggressively pursue these climate goals.
Oh, excellent. We'll go to you, Ali. Do you have any kind of final thoughts, because we're nearing up on an hour here, or anything that you think we should be particularly paying attention to as far as the energy industry is concerned?
Well, I mean, geopolitics, I guess, are always a factor in oil prices. Iran today is under sanctions pressure. I think I was in Washington last week, and I think the Americans are very conscious that you want to put pressure on Iran, particularly that it is not cooperating now on the JCPOA, but you don't want to put too much pressure. So that, I mean, you want them to go on a diet, but you don't want them to starve, because if Iran's capacity to smuggle oil out is totally cut off, then it'll lash out, and if it lashes out, it can bring massive turmoil to the Gulf, which will obviously have a huge impact on prices. So I think the Americans are trying to balance, pressuring Iran with still allowing them to smuggle and sell enough oil to China, even though they publicly complain about it, and to other parties, that allows Iran a minimum of income. Now with Russia, Russia is under a price cap, and it's trying to augment its tanker fleet. How successful will Russia be in its so-called dark fleet that is not covered by Western sanctions? That's going to be another big factor. So as usual, geopolitics will continue to play a very important short-term role on oil prices. Back to you, Tracy.
Do you foresee any potential areas that may provide conflicts that maybe haven't come to the surface yet, or areas that we should be watching that could potentially pose a problem for the industry?
Well, I mean, the one concern is that Iran is stressed internally. It is stressed also because of its domestic political turmoil and disturbances and demonstrations. It is unable to meet the requirements also of a lot of its proxy forces around the region in terms of financial help. So one always worries that Iran, under stress, will lash out to divert its people's concerns from their domestic grievances. And that remains an ongoing risk, really.
Thank you. Abdulaziz, some final thoughts, or what we should be looking at, particularly in the MENA region, the Gulf region, going forward in the industry, or any other areas that you have cause for concern or cause for interest.
I hope sound is okay now.
Yes, we can hear you.
Okay, so first of all, I would say 2022 had witnessed one of the biggest activities for government interventions into markets. And we've seen that from all sorts of governments during 2022. Would that continue into 2023 or not? The likelihood is very high that this would probably go further in 2023. However, there is also a talk about multipolarism and how multipolarism would affect the landscape of energy in the medium to long term. I would first say that none of us had actually witnessed what multipolarism looks like, but everybody's writing about it, and it's too early to realize how multipolarism would look like in the near future. But one thing I would highlight is that we tend to measure multipolarism in terms of competitiveness or the competition between nations. I think what we're witnessing now is more like a multipolarism of multiple dominance of either industries or sectors or specialties in global pockets, and that is the actual divergence between what we think multipolarism looks like from what is happening on the grounds.
So you don't see that as an immediate risk? I mean, yes, everybody's writing about it, and we've heard Saudi Arabia talk about joining BRICS, perhaps. Do you think this is, again, do you think this is an immediate threat, or this is something that is a long way away?
I think it would take a few years until we sense it. Another thing I want to highlight is we keep on talking about emerging markets. Over the past decade, we've addressed emerging markets in general, but in my assessment, these emerging markets that we call them emerging markets 10 years ago are no longer emerging. Today, they have done the emerging part. I think they are global economic powerhouses that are present in the flow of the global economics, as well as the logistical map of world trade. The crunch that we've witnessed in supply chain in 2021 and 2022 was just a sign of what that looks like. Back to you, Tracy.
Thank you. And Aya, do you have any final thoughts for us, or what we should be paying attention to?
Tracy, I'd like to comment on what Joseph said earlier, which is very, very important. And it's actually a silver lining and something to be positive about, is that some sort of sobriety is returning to governments vis-a-vis investment in hydrocarbons and the reality of us living in an industrial world. Here in Greece, because even the hydrocarbon sector here in Greece has faced the same problems as they do in other EU countries, which is underinvestment. And the complaint is that the green spell and ideology has supplanted good policy making. And I think now, when reality has struck, that you cannot divest in hydrocarbons before you have a viable alternative. This is a harsh lesson that many countries are learning. And I think that's very, very positive. I think we'll see less ideology, hopefully. Hopefully there's going to be less ideology informing our energy policies. And, faith in human ingenuity is going to be restored. I think we can reach our climate goals and invest in hydrocarbons responsibly at the same time. And it doesn't have to be either or. So I think this kind of sobriety is returning to policymaking. And that's something to be positive about.
Excellent. Thank you, everybody, for coming today, and thank you all for all my speakers. I think everybody should follow them. They're all fantastic and a wealth of information. Follow at Place Your Trades on Twitter so that you know when our upcoming spaces and other podcasts are. And I hope everybody has a great day. Again, thank you so much to all our speakers for taking time out of your day and giving us a bit of wisdom and insights